today's video, we're going to be talking about the 7 myths that hold you back from investing. Let's get into it. So the number one myth that we all suffer from, that we're mostly told by these people who speak about finances, is you need a lot of money to start investing. This is not true. One of the biggest myths about investing is that you need a large amount of money to get started. In reality, you can start investing with small amounts of money and gradually build your portfolio over time. You know, in one of the videos that I made earlier of how we can all become millionaires, I spoke about investing. So the problem is, when I was a young kid, I'll tell you a true story. Okay, story time. When I was a young kid, I walked into a bank and I asked them if I could open up an account for investing. This was when I was back in Zimbabwe. And they told me that I needed to have a minimum of $10,000 to be able to invest into the Zimbabwe Stock Exchange. At that time, I didn't know much. I didn't have $10,000. I was not working and no one was going to give me that amount of money. Back in the day, the only pocket money I got from my mother, who was a single mom, is $20. Fast forward, when I moved to Canada, I went into a TD branch and I asked if I could open an investment account. And they told me no. They told me once again, I needed to have $10,000 to be able to invest into the Canadian Stock Exchange. I didn't know much, all right? And I was just getting started. I was trying to figure out, being 24, and you're trying to figure out ways to better prepare for your life. And the financial advisor tells you it's practically impossible. So I was like, all right, cool. Okay, I can't do it. And for years passed by where I believed I could not start investing until I had this amount of money. Until one time somebody told me about opening up a TFSA account whereby you could have these investments. And what happened is, when I went to the bank, they opened up for me a mutual fund. So they told me that, oh, you can have a mutual fund. Little did I know having a mutual fund is the same as just investing. You know, so you don't necessarily need to have these crazy amounts of money. What you can have is a fund that just allows you to put in whatever amount of money you have. Nowadays, we have apps that allow you to buy shares at the fraction of the cost. In Canada, I use an app called Wealthsimple. I know in America, you guys have Robinhood. I don't know if it's still popular out there, but that's something that you had, which allowed you to trade shares at the fraction of a penny. So you don't necessarily need to have crazy amounts of money. What you just need to have is money that you can set aside. And taking advice from the richest man in Babylon, the best amount to save is just 10% of your income. The second myth is you need to be an expert to invest. Another myth is that you need to be an expert in finance or economics to be a successful investor. While it is helpful to have some knowledge, anyone can learn the basics of investing and make informed decisions. So does having information and knowledge make you better prepared to invest? Yes. Are there a lot of people who have failed with the knowledge? Yes. Because what happens with investing, what you want to think about is, the main thing that's happening is you're buying shares. And when you buy shares, you're essentially playing the valuation game. So you're hoping that the value of whatever shares that you're buying increase. So this just goes back to the basics of economics, where it's the basics of economics. Think about it as supply and demand, right? So companies have 100% shares that they can trade off. And the valuation of this is willing buyer, willing seller. So whatever buyers are willing to pay at a certain moment determine the valuation of a business. So what you're trying to do when you buy shares is, let's say you see the Apple shares today going for $50 and you believe that Apple should be valued at $100. And then you find someone who's willing to sell you those shares at $50. You buy those shares at $50, and then someone else believes Apple is valued at $100 and they're willing to pay $70. That increases the value of the stock market, and that increases the valuation. This is just a basic. This increases the value of those stocks. And when it comes to a point whereby somebody believes Apple should be valued at $200 and they're willing to pay $150 from you at $70, that's how you make your profit. But that increases the valuation of the share, and then it starts selling at $150. That's when the market is going up. How these valuations come by is dependent upon different factors. It can be a new product, a new technology, and all that. So what's happening is it's a game of valuation. It's how much do you value a certain company at a certain point, and people with billions and billions of dollars can afford to buy certain things. But once again, you have to go back to the concept of willing buyer, willing seller. That determines the valuation of a company. So what you're doing in most cases is being speculative. Once you start knowing better and better of how companies are valued, this is where knowledge in finance or economics helps, because you're able to determine the valuation of a company by reading its papers, is reading its documents. So once you read this, you have a knowledge of like, oh, this is how much this costs, this company is valued at. So if you think something is undervalued, then you purchase it. But without that knowledge, without knowing how to read company's documents, like its profit and loss and stuff like that, you can essentially discover the basics of what to look for in a company, right? So when it comes to investing, you don't necessarily have to take on the risk of investing in individual stocks. You can literally look into things such as index funds. Index funds essentially pull in everything. So you can essentially invest in what they call the S&P 500, which basically has 500 of the top performing companies in America. And then you just invest in that and let it go. Like, it's been known that it has a return of 7% on average over a period of time. So in a 20-year period, if you're putting down $200, you're essentially going to have $1 million in a 40-year period. So these are things that are well known. So these are things that you can figure out for yourself by watching a lot of finance channels. You know, guys like me can only suggest things that you can look at, and then you do a little bit more research. You don't necessarily need to be an expert. You just need to be willing to learn and open to learn, and not letting the language and jargon confuse you, because it's quite simple. The third myth that we have when it comes to investing is you should time the market. Some people believe that they should try to predict the market and buy or sell stocks at the right time. However, it's almost impossible to consistently time the market, and it's better to adopt a long-term investing strategy. So this is another thing that happens a lot of times with in any places. It's a game. So there are people who are called speculators. These are people who speculate that the stock will fall at a certain period of time. If you remember what happened with Bitcoin. So essentially what you're trying to do by timing the market is you've looked at how the market operates. So like, remember how I said, willing buyer, willing seller. Certain people are willing to buy at a certain price. Certain people are willing to sell at a certain price. So you're trying to anticipate that the stock will fall in value, and then that's when you go in and buy. Or you're trying to anticipate that if I wait a minute, this thing might go up, and then that's the time for me to sell. So what tends to happen with this is it's a myth, because it's very hard to predict human beings. It's very hard to predict what each individual is about to do, and you don't know what people are planning, right? So you don't want to play that game, because that game leaves you screwed over. What you want to do is pick your best companies and say, okay, in the long term, I'm looking at this company which is trading at $20, but I can see it in a 10, 20-year period growing into something else. And then you want to invest that way. You don't want to time the market, because it's almost impossible to predict human beings. Like, no one knows what our next person is going to do. So what you want to do is figure out what your investing strategy is, and then stick to that. Even playing it, you can be playing a speculative game. It's just you need to be sure of the risks that you're willing to tolerate and take. All right. The fourth investing myth is you should invest in only what you know. Some people believe that they should only invest in industries or companies that they're familiar with. However, diversifying your portfolio across different sectors and asset classes can reduce risk and increase returns. So this is one of the advice that we're given a lot of times by finance YouTube channels or by financiers, is that invest in things that you know. I mainly speak of Apple. I speak of companies that I work with that I understand, like, oh, I know if the next iPhone is coming out, then there's going to be more sales, then there's going to be this, that's advice that you're generally given. But the problem with that is there are sectors that you have no understanding of that are quite well performing. If you look into car manufacturing, there are those car suppliers. Those type of companies will perform better, because a lot of times, car manufacturing is not something that's going to go away, but it's something that's going to keep improving. Even if we move from gas to electronic, the suppliers are still the same. The person who's supplying the door panels is going to be the same. So those type of companies tend to be safe bets that you can look into, but you've never used before, right? So those are things that you can look at when you're investing. You just have to read. A lot of things involve reading. So you just have to read and have an understanding of which companies can you park your money in, or which investment portfolios, index funds can you park your money in. The fifth myth is you should avoid all risk. Many people believe that investing always carries a high level of risk, but in reality, there are various types of investments with different levels of risk. You can balance your portfolio with low risk investments such as bonds and high risk investments like stocks. So the key thing to anything is, when it comes to investing, you have to understand that there is risk. Whether you're investing in yourself, whether you're investing in a car, whether you're investing in your children, the essence of investment comes with risk, because you're putting in something that's not guaranteed. You don't know that by investing in yourself, will you be able to implement what you've invested in. That's the risk that you're taking. So you cannot avoid risk. Like, it's almost impossible to invest risk. Each decision that you make in your life carries risk. So when it comes to money, the last thing that you want to be worried about is, oh shit, what if I lose my money? No. There's that frame that's been going around, fuck around and find.
All right, today we're going to talk about how we can find out and how much we can find out and what it takes to get there. So first we have to decide how much do we want to find out. So let's say in this case, I want to find out at a level of 7. Okay, so I find that level on my graph and I come horizontally to my gradient line. Where it intersects with my gradient line, I'm going to come straight down to where it intersects with my fuck around line. That there is going to tell me how much I have to fuck around to find out what I need to find out. See, as you can see, the more you fuck around, the more you're going to find out. And also, if you stay down here and you never fuck around, you'll never find out. So I hope this lesson is helpful. Thank you.
Find out. That's essentially what you have to do, is you have to find out what will happen if you take your money, but you have to be willing to understand what's your appetite for risk. Some people have a high appetite for risk. That's when you're investing in things such as crypto. Good luck to that with that. That's a high risk bet. And then there are things such as bonds, which tend to be low risk, but it's not that you avoid any type of risk when you make those investments, because what happens in those kind of investments is the government can, mess it up and you end up screwed. So you just want to understand what your appetite and what you're willing to lose, and have that deep understanding when investing, and knowing that I may lose and it's part of the game. The sixth myth that holds you back is you should aim for high returns. Some people believe that the higher the returns, the better the investment. However, higher returns often come with higher risk, and it's important to understand the level of risk associated with an investment before making a decision. So one of the challenges that we have is, you know how people say high risk, high reward. Yes, that's true, but that doesn't necessarily mean just go for those bets, because what you don't want to do is to risk everything and lose everything, right? So you want to be very careful and have an understanding of, okay, these are my crazy risky investments, and then these are my, subtle, because, having a 30% return and having something that gives you 5% return year over year, there's something called compounding interest. So you want to have a balance, a healthy balance. Everything is just about doing it in moderation. Don't be out here risking everything that you own, because listen, when you lose that money, we will all be like, shame. I won't even be there with you. You watch my video, but you're the only one who has to pay the price. I won't pay with you, unfortunately. The seventh myth that holds you back is you can get rich quick. Some people believe that you can get rich quick by investing in certain stocks or schemes. However, building wealth through investing takes time and patience, and it's important to have realistic expectations and long-term investment strategy. All right, so just like in anything that you're investing in, getting rich quick is almost impossible. I've been doing this for almost 3-4 years now, and I've made literally little to no money. But if I tell you how much I've invested into trying to make content, into doing this, it's a lot of money, right? And I did it thinking that if I do it real quick, I'll start making all that money back, but I haven't. It's the same thing with investing in the stock market. You're not really going to make a lot of money in the beginning, but by sticking to it and having a long-term strategy, it will guarantee you will make money. It's very difficult for me to say, oh, you're guaranteed to make money, but you will make money, because we've seen people make money, right? So what you want to do is have an understanding that it's almost impossible to be desperate. You don't want to be desperate when it comes to investment. The only way that I've seen that solves a money problem is having a money source, right? So what you want to think about is, where can I put my time and effort into generating income that makes me money? That's how you become rich. You want to find ways of generating a lot of cash, not investments. Investments build wealth. If you're on a wealth building journey, then investing is one of the best things to do. That is investing in the stock market, but also investing in yourself. This is more of if you want to build that slow wealth that stays. But if you want to get rich quick, man, all I can say is you want to look for ways that make you money real quick. Playing the lottery, being a thief, I'm not encouraging it, but all those things, the problem with them is the quicker they come, the quicker they go. So you want to be very careful. The best way in those instances is to become valuable, but as well, that takes time, because you have to invest in yourself, which might take you 4 years of getting a college degree, another 2-3 years of gaining experience, and then starting to see the benefits of your results. So it's very difficult to pick anything that can quickly pay you back. whatever it is. But there are many ways people have been making money from things such as OnlyFans. So, hey, there's a suggestion that you might want to take in. With that said, man, if you need help setting some of your financial goals, click on this video. Otherwise, I'll be seeing you in the next one.